Welcome back to another episode of the Lucky Lenders Homebuyer Education, where we explore tips, tricks, and stories that can help you plan for your next home purchase. Whether you're a move-up buyer, a first-time buyer, an investor, or just looking to learn, we hope you gain a little bit of knowledge today. Today's episode may challenge one of the biggest narratives that we have in real estate, which is, well, Charlie, I'd love to move, but I got this 3% interest rate, and rates are just never going to be that low again, and I'd be silly to give that up, right?
It is such a common piece, and it's kind of like hitting a lottery back in the day. It's great. I had one of those, but we all have things that we want to do and want to grow or change or not drive as far. So it's a tough one, but it's not the last thing and the only thing you need to look at.
Yeah, according to the CFPB, nearly 60% of active mortgages carry an interest rate below 4%. Economists call that a lock-in effect. People don't want to move because they've got this amazingly low rate, but that's not necessarily what we want to talk about today. Today, we're going to ask a little bit different of a question, which is, what if your mortgage rate isn't the only rate you should actually be thinking about?
Love it.
So we're going to talk about what I call your household interest rate. Charlie and I have updated our spreadsheets. We look at this with people that are willing to show us what all they have for debt out there. And it really becomes more of a weighted average across all of your debt, not just your mortgage. Sure, your mortgage might be at 3%. You've got credit cards, you got car loans, you've got whatever, boats, you name it. All these other things out there are going to carry higher interest rates. And we're also in a world where I think just the other day, Charlie, we heard that homeowners have more home equity than ever before.
Yeah.
So you've got all this home equity, which really doesn't mean much if you're not using it. However, if you've got some debt out there, we really need to determine what is your weighted average or what is your higher rate than your 3% of your mortgage. And maybe we can use some equity to pay that off.
Yeah. And we really hope that there's not a lot of other debt out there, but let's be honest, things happen. People get their HVAC, falls out, needs to get a whole new system, and it's $5,000 to $10,000. Most people do that financing. And so there's all sorts, like you said. But when we look at rates, you can have one really good one, and then all these other ones could be 30%. We've seen that. Hopefully it's not that bad. But even if you have those, we don't want to focus on just the one. We want to look at all of them. And I don't know, how many times have you seen, Kyle, where the other debt's actually higher than the mortgage debt?
Every time, I think. Credit cards average 20, 30%. Auto loans nowadays, they're up there around 7 to 9%. You got personal loans, 10+%. You got home improvement loans. And then don't forget Klarna, our buddy Klarna, and all of those other buy now, pay later programs that are out there that, they seem really great. And I see a lot of people that take advantage of those. Unfortunately, they can be a real pain in the butt because you've got all these extra expenses the underwriting now has to account for. Well, I make my payments, Kyle. I always pay those off. That's just stuff. It's the same thing as a credit card. It's just a temporary credit card.
And I think the biggest thing you and I focus on is we want to see it well-rounded, but honestly, we want to see less stress, less hassle, because we're all swamped. It doesn't matter what you're doing. You could have a quiet week, but the week before was nuts. Work, kids, family, medical, whatever the case may be. If we can get rid of all these things, you don't have piles of paperwork that come in the mail and bills you got to pay. Maybe you don't get print, maybe it's emails, whatever, but you've got those notices. I love seeing people have less quantity of accounts and therefore less to manhandle, less to think about, and hopefully you can take and make not just the interest rate drop or the payment drop or both, but you can get rid of a lot of that stress and enjoy life some more and open up to where the new house is an option or remodeling and adding on to your house, whatever the case may be.
So let's do an analogy here. So imagine your finances are like a baseball team. Everyone talks about that star pitcher. I think of the Brewers. They've got a guy who throws an average of like 104 miles per hour. Just to average that is insane. The guy is a freak. But championships aren't won by one player, right? He can pitch all the time until his arm gives out. Charlie's shoulder's already hurting thinking about it.
Wow.
Championships aren't won by just one player. It's kind of like your finances. Your mortgage rate is not the only interest rate that you need to be paying attention to. You need to start thinking about all the other rates that are out there. And also, credit cards, we talk about 20, 30% interest. Maybe you're making the minimum payment. If you make your minimum payment on your credit card over the next 30 years, you're still going to make you that minimum monthly payment because that continues to compound. If you do that same thing on your mortgage, over the next 30 years, you're going to have it paid off. It's a little different. That's the 20 or 30% is what we think about. But if that just continues to compound and you continue to just pay and pay and pay and pay, you're never going to get rid of that thing. So using that equity can be a huge advantage.
I totally agree. And I love the sports analogy, even though I'm not the sports guy. So I'm going to throw one more. And Kyle, do you do anything else to your car, or do you just change the oil?
Well, I don't even do any of those things, but I
But you
really
pay for it.
I really just change the oil, and then the other car guy gets mad because I
Yeah.
should be doing more than just
Well,
changing
just
the oil, apparently.
Ignore the tires, ignore the brakes, ignore the windshield wiper fluid, ignore everything else. It's not going to turn out good. We want to have that well-rounded, but I do love the picture story. Oh, man, there's no way I could do 104 mile an hour average. I don't think I
You
could do
couldn't
50
do
mile an hour
104 mile
average.
hour. You couldn't throw 104 ever.
Well, I'm sure at some point, maybe once.
I don't think so. I don't believe it.
Oh, I gotta love it. So how do we get this to where it conveys into an actual money situation?
Well, I think the biggest thing most people aren't really considering is, sure, I could refinance, Charlie. I could refinance and I could pay off my debt. Then I'm going to have a higher mortgage payment and a higher interest rate. And that is something that could potentially make sense. You know, if you've
It's
got
possible.
a lot of equity and you don't want to move, you love your house, it is something that could make sense. However, going back to what the economist talked about with that lock-in effect, a lot of people are not selling because they don't want to lose out on this really low rate. They're not thinking about that, what I call household interest rate, all the other debt that you have. And so when you start thinking about it from a bigger picture, okay, actually, Charlie, my house is no longer fitting my needs. I either need to, downsize, or maybe I need to get a bigger house, or, we're
Just different area. I mean,
Right,
you might
or-
have changed jobs. You don't want to drive the same distance.
Exactly. So if you need to make those changes and you're really worried about losing that interest rate, think about it of, well, I can use the equity that I have in my house. And again, that equity doesn't really matter unless you're using it, because ultimately you could have 100% equity, but if you're not going to take out a loan against your house, it doesn't mean much. Or you don't sell your house, it doesn't mean much. So we sell your house, we use that money to pay off all your debts. You got one mortgage payment and you've got one new debt payment, and that's it. That's the mortgage. And you've got that new, nicer house. You've got however it fits your needs. It's bigger. It's closer to work. It's whatever. It's closer to grandchildren. And now you don't have any other debt payments. You've got the one payment. So when we look at that weighted average, we can say, well, the weighted average on all my debt is actually 9%, and mortgage rates are 6.5%. Well, shoot, actually, I got a lower interest rate. I'm actually going to be paying this off in the 30 years, and I can get rid of all that other stuff. I've just got one payment. So it can get you out of that house, get you what you want, and you can really take advantage of all that. And you can still, I'm sure that your monthly payment on all your debts is still going to be more than what it would be with the newer house, as long as you're within reason. Obviously, you're buying a $2 million house, your monthly payment might be going up quite a bit, but within reason, it can, most of the time we see people that can upgrade and they actually have a lower monthly payment on the new house than they do on all their debts right now.
Yeah. And that's one of the big keys that people don't believe us until we start to run the numbers. And a lot of them, you can even get it to where you're doing a shorter term. We do typically start with a 30-year. We'd rather see most people have a comfortable budget and then really do a good job putting money away in savings, retirement, emergency fund, whatever. And then as you have extra money, great. If we can pay the mortgage down, that's awesome. We'd love to see you debt-free completely someday, but it's got to be within reason. But maybe get that 25-year term or a 20, and if we're even lucky, less. 15-year rates are wonderful. We just got to make sure that payment plays nice, but a lot of times it can. The minimum payments on so many other accounts are really high. Car payments are quite high. Credit card payments are 2, 3, 4 times on the minimums of what they were not that many years ago. So, like you said, that household rate, that total payment, and that total rate, we really got to look at those, because there's some really cool stuff you can do with your equity and get into that house that you either, like you said, maybe you're upsizing, maybe you're downsizing, maybe it's just a different area.
So I've got an example of this. I'm not going to name names, but I had a customer and they had a 3% interest rate. They had about $35,000 in credit card debt. They had a car payment that was about $700, which unfortunately that's fairly low. Nowadays we're seeing much higher than that. We talk all the time about how many $1,000 plus car payments we've seen out there. They had a couple of personal loans just from stuff that happened with the house. One, they needed to get new windows. The other one, they needed to put a water heater on, and just little things like that just start to add up. I think the new windows, in fact, didn't have a monthly payment on that. So they said, well, I don't pay interest for a couple of years. So they weren't making any payments on it because they just saw it as, well, I'm hoping to, maybe sell my house someday so I don't have to worry about that. So they've just been letting that sit there. But the home really doesn't fit their needs. That's why they were thinking about it. So now they're going to be buying a new house. They're going to pay off all that debt, the $35,000 in credit cards, the car loan, the personal loans, the windows, all that stuff. All that stuff is going away. And they're going to have one new mortgage payment, and they're going to be able to save a lot of money every month, which allows them to then, if they want to pay extra towards it, or they liked having things, right? That's why they had that other debt out there, is because they like things. Well, now if you've got $700, $800, $900 back in your pocket every single month, you can still buy those things. You just no longer need to put them on credit cards. Now you've got the cash to do it, and you can go out and purchase those things that you're looking for. So sometimes staying put makes sense. Other times buying a new house can make sense.
Yeah. And being confident in it. I love that. That's a great scenario. And it's not even an extreme one. It's a fairly common one. But we get into some of the extremes. It makes a big difference. But either way, the confidence level in your money being your money. So when it comes in, it's not just poof, gone because you've got all those things that you pay right away. It is so much fun on our side to see people get more money that stays in their account. So now you can actually say, I can save for a vacation. I can pay down some other debt. I can put a new addition on my house in a couple of years, knowing you can convert paycheck to paycheck into paycheck that I get to keep more money each time. I love hearing those success stories because that stress level, you get to enjoy your spouse, enjoy your family, and actually see yourself grow versus just treading water. That treading water is exhausting.
Exactly. And again, going back to that lock-in effect. So millions of homeowners are choosing not to move because they want to they don't want to replace the historically low interest rate, which has contributed to fewer houses being listed. Sure, we've got a lot of houses in the inventory right now, but there's way less buyers out there because people don't want to go out and buy because they'd have to sell. Right? But according to the Federal Reserve Bank of New York, Americans now carry well over $1 trillion in credit card debt, while the average credit card interest rate is above 20%. $1 trillion, right? So when we talk about all this equity that's out there in your homes that you're not using, you can use that money to pay off some of that credit card debt. And I mean, I often find Kyle, we don't have a lot of debt. We just pay it off every month, right? But it's thousands and thousands of dollars. Just a little bit of extra cash could make you so you don't have to do that anymore. Now we're just living off of the cash that's coming in instead of living off of credit, especially since credit cards are talking about getting rid of the bonuses and the perks and all that kind of stuff that you're getting. If those go away, I don't have a reason to use my credit card anymore. Now I can totally just use my debit card.
And that's something we really haven't talked a lot about. We should do a whole episode on. I'm trying to carry cash more because you're having that 2, 3, 4% upcharge to use your card, and you're negating any of the points that are there anyway. And so those of us who pay our cards off, they're not making any money at that point. So, I mean, the companies are not enticed, but those who leave the balances, which we'd love to see everybody not carry a balance. If you can get to that point, it's a great way to go. But yeah, the dynamics are changing.
Yeah. All right. So 3 actionable takeaways. 1, build your household balance sheet. So list every debt you have right now. Go through your mortgage, your credit cards, your auto loans, student loans, personal loans, home equity, Klarna, buy now, pay later type things. Write down the balance, the interest rate, and the monthly payment, and then throw it into GPT. Ask it to tell me, hey, what's my weighted average based on all these things? It's going to give you a good number. It's going to give you an exact number, in fact. Secondly,
if that overwhelms you, though, don't worry about ChatGPT. Call us. We'll walk you through it. That honestly is one of the hardest steps for people because you really got to do a gut check. We can do it with you. There's no judgment. And a lot of times when you have somebody hold your hand, you're not doing it by yourself. You keep your head from spinning as much because you can get somebody with a little bit less emotion. We don't have the emotion that goes along with the personal stuff for each of the people that we work with. So sorry to interrupt. Good point.
No, it's total side note. I think of this, like you just said, the emotion. We don't have that. I mean, somebody the other day said, Kyle, now don't go sharing my social security number. I understand that there's an emotional feeling when you give out your social security number to go through the application. I write it down. I don't remember. Like 5 minutes later, I have to go back to look at your last 4 when I'm sending out a request to the system because I don't remember it and it's not something that matters to me. So it's that emotional connection that you have to giving something. And so if you can get it out of your head and get it into our spreadsheets and we can help you, absolutely. Secondly, focus on monthly cash flow. So ask yourself, which loans are costing me the most each month? Which debts are preventing me from saving? Would eliminating these high interest debts improve my financial flexibility? Can I just have a little bit more freedom in my monthly budget by getting rid of some of these things? Finally, consider lifestyle alongside the numbers. Finances matter, but so does living in a home that fits your needs. Ask yourself, have we outgrown this home? Is the commute hurting our family time? Are we paying too much in gas because gas is up to $4 a gallon in Iowa and it's ridiculous? Are we maintaining more house than we really need? Do we need to downsize? So there's just a lot of things, a lot of questions you should be asking yourself, asking your spouse, and understanding, should we be moving? Should we be staying put? How can we free up some extra cash in our budget? So
Love that list. Nice work.
So this episode isn't about convincing everyone to sell their home. In fact, most people are probably not going to consider selling their home, and that's totally fine. But it is meant to help you think about, is there something out there that I can be doing that can actually help me with my budget? Maybe that interest rate that I've been protecting is really not that important. And maybe I need to be looking at the entire financial picture. So run those numbers, call us. We're happy to help. And we hope that you learned a little bit from this episode today, because it's ultimately the goal is to teach you guys what we're talking about. So, and I guess lastly, we hope you found this episode enjoyable today. Every situation is different and unique, and the right answer starts by looking at all the numbers. So be sure to follow us on all social media platforms, subscribe to the podcast for more exciting episodes, and remember, stay curious. We'll see you next week on The Lofty Lender.